Hey everybody, this is Stacking Cash. If you're new to the channel, I would like to welcome you and feel free to subscribe. If you're not new to the channel, welcome back. Glad you're here again. In this video, we're taking a look at Tesla earnings for Q1 2022 that were reported last night. As you may know already, Tesla beat many of the estimates. Tesla reported top and bottom line beats, margins jumped as regulatory credits soared, and shares jumped on Wednesday evening in the after-hour session. Last night, after the closing bell, we received the first quarter results from the electric vehicle automaker Tesla in the shareholder letter. Investors were curious to see how the Shanghai shutdown in Q1 impacted the results, along with the start of the production in the two new factories, Giga Berlin and Giga Texas. In the end, the headline numbers looked tremendous, but they did contain one major asterisk that could limit the enthusiasm a little bit. It was widely expected that Tesla would once again beat street estimates that were again ridiculously low. The company did just that, coming in just above $18.75 billion in total revenue and $3.22 in non-GAAP earnings per share. That is nearly $1 billion ahead of the top line and $1 on the bottom line. So what caused this big surprise? Well, it was one of the big points that the bears have trumpeted over time, and that was regulatory credits. Tesla reported revenue from these credits of $679 million, more than double the $314 million reported in Q4. On the call, it was stated that a change in the CAFE rules resulted in a $288 million one-time credit benefit. On the margin side, Tesla reported GAAP gross margins of 32.9%. This was up about 230 basis points over the Q4 levels. However, a good chunk of that, 150 basis points, was due to the credit sales. But overall, auto margins still rose. As expected, price raises were likely to flow through, which they did, with the average selling prices per delivery rising a few percent, and Tesla was able to overcome some inflationary headwinds out there. Both energy and service margins weakened, coming in below what was expected. Research and development expenses were a bit higher than expected. With Tesla now producing solid GAAP profits, cash flow again came in strong. Free cash flow was more than $2.2 billion, although that was down more than $500 million sequentially. Tesla's accounts payable and accrued liabilities again rose, this time by more than $1.3 billion over Q4 levels, and days payable outstanding jumped 7 days sequentially. The company reported a net cash increase of nearly $2 billion to $12.7 billion United States dollars. As expected, management's guidance in the shareholder letter was extremely limited. The company reiterated its 50% long-term unit growth forecast while stating that supply chain challenges have kept factories running below capacity. There were no current production run rates given in the letter for either of the Shanghai factory in the near term, which has reopened on a limited basis, or the two new facilities in Berlin and Austin. However, on the conference call, Elon Musk said he thought a 60% increase in deliveries this year was still possible. For Q2, he said that production could be lower than Q1 or about the same, or maybe even higher, so it's all a guess at this point. In the end, Tesla impressed with its headline results, although the large amount of regulatory credit sales takes a bit of a shine off the results. Those sales, along with price raises, helped boost margins over Q4 levels, so Tesla's results handedly beat the usually low street estimates. Tesla shares are up about 7% on the news, which I think is a fair reaction for now, as I don't believe that these Q1 results do much either way to change the long-term narrative. If you are interested for more Tesla news, I would recommend to subscribe to my channel. This way, next time I upload other Tesla or other EV news, you'll be notified by YouTube. Thank you so much for watching and have a wonderful day.